The broadcast is now starting. All attendees are in listen-only mode.
Hello everybody, welcome to Bursa Malaysia's webinar number 4, Principles of Value Investing. Now, before we proceed further, just want to do a sound check, and if you can hear me clearly, could you please click raise the hand button? If you can hear me clearly, could you please click the raise the hand button? Alright, I'm seeing many hands now. Excellent, thank you. You may put down your hands. Yeah, today our topic is on principle of value investing. Now, as usual, this webinar is 90 minutes long, where we have 60 minutes for content, about 30 minutes for question and answer sessions. So in this session, we are going to dissect what are the major asset class for us to create wealth, and how do you assess the risk of the business, and how do you analyze stocks as an ongoing business, and ultimately you will learn the 52-week timing risks and strategies from David. All right, so we are very honored to have invited David, who is from Spiral Thinker Alliance. So disclaimer, now whatever we share in this webinar is only for educational purpose only. So in no way that we give any recommendation for any stock or buy or sell. So if you decide to buy any stock or sell any stock, you do it at your own risk. Is that okay? Now, cool. So we have in 2018, we have a series of webinars in store for you. We have done the first 3 in January, February, and March, and now we are on the 4th sessions that we'll be talking about principle of value investing. Subsequently, we have one webinar every month in store for you, and here is the calendar. The next one will be on 8th of May, where we will open registration for it at the end of the webinar. Now, without further ado, let me introduce the speaker today, David. Now, David is an engineer by training. He began his career in the telco industry for 10 years before turning his passion in value investing. He served as a director in a local equities education and research firm for 3 years, managing research efforts and delivering advanced value investing and portfolio management education series. Thereafter, he has stepped out to pursue his own aspiration by establishing the Spiral Thinker Alliance. It's a collaborative alliance to promote intelligent value investing. Wow, what is intelligent value investing? Now, maybe you can ask him a bit later, okay? And he also developed adaptive portfolio strategy for sustainable long-term wealth creation investing in equities. Now, he's now a full-time private investor and dedicates his time and resources to nurture the youth in financial literacy, as well as providing value investing ideas and portfolio management strategies for high net worth individual. Now, I've known David for years, and he's a very accomplished value investor who has taught many students. Now, without further ado, let me hand it over to you, David. I'm making you the presenter now.
Okay, great.
We can see you on the webcam. Yeah.
Okay, great.
Take it over.
Okay, thanks, Shane. Chun Xian, thank you very much.
Yeah.
Thank you for inviting me to do a webinar with you guys tonight, as well as I would like to thank Bursa for organizing this educational online educational workshop, which is, I think, great. I wish that I had something like this when I was young. Well, anyway, so without much further ado, today the title is called Principles of Value Investing. So what we're going to talk about is nothing too complicated. Basically, it's very simple, very easy to understand. So what I'm going to do is going to provide a framework for you guys so that you can go back after listening to this webinar to try to practice on your own. Following up what Chun Xian said just now, in fact, previously, before I became a full-time investor, I was an engineer like you guys, like a lot of you guys, I believe. And, you know, being an engineer and without any financial background or accounting background, I totally do not understand what this, how to read financial statements, much less investing in stocks, right? So what I did was, you know, I tried to do this technical analysis. Didn't work for me. But later I found out what is value investing, and it is a very simple way to actually invest in the stock market. So today, what I'm trying to do is try to present to you, all right, share with you how I do it, all right, on a very high level manner, okay? If you have any questions, just feel free to drop your questions on the panel. Okay, now let's start. Before we talk about the serious stuff, let's look at this very simple topic of why is it important for us to invest? Yeah. Now, perhaps you haven't thought about this before, but it is important for us to take a few minutes, all right, to try to understand why we need to invest. Now, if you look at the screen in front of you, this is from the famous Robert Kiyosaki 4 quadrants of cash flow. Basically, you have E, you have B, S, and I. E stands for employee, meaning you work for somebody. B stands for business owner, meaning you own any business, all right? You hire people to do work for you. And S is self-employed. Okay, like myself, I'm self-employed now. And last but not least is I, investor. Now, I'm sure that there are a lot of youngsters listening in right now. You may be in your university. So after you graduate, chances are what's going to happen is you may be looking for a job. Yeah, and most of the people out there, most of the people in society today, they are employed by a company or business owner. Now, when we are an employee, we dedicate 100% of our own resources, our time, our health, our skills to derive income. That's what you can see here, right? Now, but what happens when you get sick? All right, does your boss pay you when you don't come to work? Or what happens if your company falls after you work for the company for 10, 20 years, right? So there's no security in this sense. But don't get me wrong, I'm not saying that being employed is not good. I think when we are working for someone, we always have to have a plan B, or a plan in mind in case something happens to our job security. Now, then there's a second class of people who are the business owners. Business owners understand that they've got to leverage on people, all right, to help them make money. So John J. Paul Getty has a very famous quote. He says that I would rather earn 1% of 100 people's effort than 100% of my own efforts. So basically, you are leveraging on people's skill, all right, to derive income for you. So you own a system and people work for you. So people derives income for you. Right? If you're self-employed, you use your own time, you use your own skill, or you use your own resources to look for income. Right? Now, in the future, regardless whether you decide to be employed, you decide to have your own business, you decide to be self-employed, the most important thing is you've got to be an investor no matter what quadrant you are in. The reason is very simple, because investor understands that money works for them. So money works for them even when the investor is sleeping, when they're on holiday, all right, very different from when you're employed. That is why from the beginning, it is very important to understand the importance of investing. And the income from investing is not dependent on the presence, because you as an investor, you own a business, right? And people, your CEOs, your CFOs, your managing directors work for you to make income for you. And hopefully in return, the value of the business will go up, and hence your investment value should go up as well. Yeah. So basically, that's the simple reasons why we need to invest. Then comes the next question. So yeah, I'm interested to invest. What should I invest in then? Yeah, investing is not all about stocks. In fact, there are many different types of asset classes we can use to employ to invest. Now, let me go to the next slide. Yeah, so this is the fundamental different classes of assets that we can invest in. From the cash to bonds to properties to equities and so on and so forth. This does not encompass all the asset classes available, but this is a very scaled down, simple version. Now, on the left-hand side, you can see the vertical scale, it signifies reward, whereas on the horizontal scale, it signifies the risk. Now, generally, what people generally agree is that when you take more risk by right, the reward should be higher. But don't forget that when you take more risk, chances are higher that you may lose your capital as well. So you got to always be mindful about the risk you are taking. Now let's take it from the top. On the cash, now, actually, when you hold cash, is there risk? Definitely. You run the risk of losing your cash. Your cash is at risk of being what's the word? When inflation will actually depreciate the value of your cash. So the next best thing to cash is actually government bonds. Government bonds or any corporate bonds is basically an IOU. It's a paper whereby you buy the bond from the government or the company, and they promise to give you a certain interest rate over a fixed number of period of time, let's say 10 years. Then after the time expires, they'll redeem the bond from you by giving you the price that you paid for the bonds in the beginning. Yeah, so bonds are generally low risk because good companies, especially, they should be around. Governments, all right, should be around. They should do a good job governing the country as well. But don't forget that sometimes company may fail, governments may fail too. Just look at Greece, just look at Spain, just look at Venezuela, so on and so forth. Now, next on the scale is actually the properties. Properties is perhaps something that most of us are familiar with. All right. When you buy a property, you expect the price to go up, right? And along the way, you can rent the property out, okay, to your tenants. Then you derive what we call the rental income. But don't forget that property is only considered an investment if you do not stay in the property. If you stay in the property, it should not be considered an investment. All right, properties as an investment are the shop houses or the apartments that you buy with the intention to rent out to tenants to collect income. All right, now then comes the equities. Equities among the four are perhaps the one that carries the highest risk. Yeah, basically, you are, when you buy equities, you are buying into a portion of a company, right? The other name for equities is actually stocks. Now, let me show you what does a stock traditionally looks like. Okay, now I've got this from Google. All right, it is the stock certificate of Coca-Cola Company. Basically, if you buy a stock, let's say one share of Coca-Cola Company, you're buying an ownership of the company. If you buy 100 shares, you buy 1,000 shares, you buy 100,000 shares, you are still buying a part of the business. So as the business grow, by right, they should be more profitable, they should have more sales, they should have more cash flow, and by right, they should give you more dividends. And that dividend, is your part of your income from investing in this company. So apart from the dividends, as the business grow, the value of the stock should go up in tandem as well. So this is when you can start to realize your investment to make a profit. I checked history price already. If you have invested in Coca-Cola 20 years ago, all right, your investment would have compounded at 8% per annum. Then you may be asking me, hey David, 8% per annum doesn't sound very exciting, Why don't I just do Bitcoin? Can give me a couple of 1,000% in a year. But don't forget, we are investing in a company, right? And don't underestimate the power of this 8%. Let me give you an example. Okay, so I'm going to switch my screen to this website called FN Calculators now. So you can use it. It's very friendly. I think the finance or the accounting students will be very familiar with this thing called the TVM, time value of money. Now, basically, example. Say you start with an investment of 10,000 ringgit today, okay, and you hold this for 20 years, okay, and it's compounding every year at say 8%. So what happens to this 10,000 ringgit after 20 years, assuming it can compound 8% per annum, just like Coca-Cola? Your future value will be about close to 50,000. All right. Now, this is the money. Okay. If I go back to my slides, this is the money. Okay. Can I do this? No. screen pointer options pen. This is the money that is working for you when and does not depend on your presence. Okay, this is the money. This is the company that has a management team that tries to grow the business for you. Now, then you may think, hey, what if I can save some money better? If you can save, let's say, $500 a month, so in a year you would have saved $6,000, for example. Okay, and you continue to do this for 20 years. All right, your investment from 10,000 up to 20 years could go to 300,000, as you can see from here. Yeah, if you have slightly more money, 20,000. If you have slightly more money, let's say 20,000 to start with, all right, then your future value will be even higher. Okay, now 8% is quite a safe, I would say, realistic compounding annual return that you can look for. Now, if you are more skilled, if you're more seasoned, you are more, you go to classes, you understand how to look for businesses, right? Probably you can actually do 15% per annum, and coincidentally, that's my personal target, 15% per annum. All right, when I invest in stock market. So if I can do 15% per annum, and based on $20,000 today, I save $500 a month for the next 20 years, this 20,000 ringgit will grow close to 1 million, all right, in 20 years. Now, ladies and gentlemen, that's the power of compounding. Yep. So you may be asking, it should be clear to you now that stocks is one of the best asset class to invest in, all right? And if you compare to properties, properties on the long term should grow between 8 to 12% per annum as well, excluding the dividend, excluding the rental. But there's a problem with property, in my opinion. Now, let's say suddenly sometime down the road, you need cash, and you need cash urgently, right? Can you say, hey, I just want to sell off my rooftop. I want to sell off my tiles to raise some money so that I can pay something. All right, you can't. Now, even if you can find a buyer to buy the entire house or property that you own, the S&P process, the sales and purchase agreement process, may take you months or 2 to 3 months. All right, but equity is different. When you need money, all right, you can straight away sell the stocks on the hand at a compelling market price. And you don't even have to sell everything. You can sell just enough, because equities is very liquid. And that is one of the main reasons as well that I like to invest in equities. Yeah. Now, you may be asking, next question is, hey, but I heard, investing in stocks is very risky. Well, it's true, and yes and no. Whether investing in stocks or equities is risky or otherwise depends entirely on what you're doing. Now, so in front of you, there are two ways of participating in the stock market. You can either be a speculator, you can either be speculating, or you can either be investing. Now, what's the difference between these two? All right, let me put it in a very simple way. I believe that among some of the listeners tuning in today, you would have or may have bought a stock recently. We know with all the market sell down recently, very exciting, right? Red seed market. Let me ask you a question. What was the reason you buy that stock? The last stock you clicked the buy button. What was your reason? Was it because you understand the business and you feel that right now with the price coming down, it's a steal, it's very cheap, or is it because your friend told you to buy, or you read it from somewhere, you read it from a forum, or your good friend tells you, or your girlfriend's parents say, hey, you must buy this stock, and you go and try it. All right, so you can understand. All right, one is investing, the other is speculating. When you invest, you've got to understand. When you invest in a stock, you've got to understand what does the business do? Because behind the stock is actually an underlying business. It's a business that is ongoing, that is selling something that the society needs. It is selling something that you and I need, right? It could be selling food and beverages. It could be selling services like the banking services. It could be selling cars. It could be selling electronics. You can be selling consumer devices. You've got to understand what the business does. And not only that, you've got to find out, are they profitable? Are they fair to you? Is the management fair to you as a shareholder? Yeah. There's nothing wrong if you want to speculate, but make sure you know what you do. Most of the time, the most dangerous place to be is actually between these two. This line here is actually the most dangerous place to be when you don't know whether you are investing or speculating. Yeah. There is when you can, you intend to be a speculator, but because you chose the wrong stock, the stock price tanks, then you become a long-term investor. That's not investing at all. Okay, so, and a lot of people has come to me and say, hey, David, the stock market is so volatile. Today, the stock may go up 10%. The next day, it may come down another 10% or even worse. This is what we call volatility, because stock price changes every single day. In fact, if you glue your eyes to the trading platform every day, stock price changes every second. So this is what we call volatility, right? And a lot of people associate risk with volatility. Now, let me ask you this question. Is risk really volatility? All right. So I'm going to bring out this gentleman here. Every time we talk about value investing, for sure, we have got to quote something from Warren Buffett, right? He is the most celebrated figure among the value investors. So he has been a value investor for more than 50 years, and his compounding annual return is about 20% per annum, which is a huge deal. All right. Okay. So Warren Buffett says that risk is not volatility, which I totally agree. So because he's from US, this small town called Omaha in Nebraska, where there are a lot of farms. So he usually quote what he knows, and he has a very famous quote. He say that when farm prices crashed, farm price volatility went up. Now, a farm price, before that. So what he mean by price volatility went up? Because as the prices of the farm crash, yeah, the price will swing, from a very high to very low, so on and so forth. So he says that a farm priced at $600 per acre that was previously selling for $2,000 per acre is not more risky because it is more volatile. All right. Now take a second to understand the implication of this quote. Okay. When farm prices crash, price swing up and down. All right, because a farm that was previously selling for $2,000 per acre now is offering for you at $600 per acre. It's not more risky because it's more volatile. Yeah, think about it. Now, if you can understand this quote and you can see what the relevance or the logic behind this quote, what I want you to do next is just change the words farm to stocks, like what I'm doing here. Right? So, in the same logic, when the stock prices crashed, the price volatility went up naturally. Now, a stock price at $6 per share that was previously trading at $20 per share is not necessarily more risky because it is more volatile. Yeah. Now, in this regard, you have to understand what you are buying. Okay, it doesn't mean that any stock that crashed from $2 to 60 cents is safe. Please don't misunderstand my intention here. Now, what Warren Buffett is trying to say, or what I'm trying to present, trying to share here, is that risk comes from not knowing what you're doing. Risk comes from not knowing whether you are investing or speculating. Risk comes from not knowing what you are investing in. And this is one of the most famous and most important quote by Mr. Warren Buffett, in my opinion. You've got to understand what you're buying. You've got to understand what you're holding. Otherwise, what gives you the confidence to buy the stock when it's coming down? All right. Okay. And of course, after this, I'm going to show you how do we determine whether there's a value in a company. All right. So for that, I've got to apologize. All right. The next 10 to 15 minutes is going to be a bit dry, but I'm trying my best to make it as simple and as interesting to you as possible. Now, next slide is going to talk about how do we analyze a stock as an ongoing business. Okay. Now, for those of you who are from the finance background or from the accounting background, this should be a very this should be like a walk in the park for you. But for those of you who are from technical background, you absolutely haven't read a financial statement before, I'll try my best to make it simple. Okay, now what you have in front of you are basically the three main financial statements that any company has to report every single year. Okay, the first one, and which is probably the most popular one, is what we call a profit and loss statement. Okay, profit and loss statement. It has other names. Sometimes I think now it is called income statement, but they mean the same. Now, next, I think most of us are familiar is the balance sheet. Okay, the third one is perhaps the most misunderstood of all, or the most scary one to many people, which is called the cash flow statement. Okay, now, basically, when we read a financial statement, we read from profit and loss to balance sheet to cash flow. So what is contained in a profit and loss statement or an income statement? Now, normally, how we read it is we read it from the top. Okay, the first line that a company report is usually the revenue. All right, it has other names. Sometimes it is called sales, it's called turnover, revenue. They basically mean the same thing. Now, because they are the first line item in a income statement, in a profit and loss statement, sometimes it is referred to as the top line. Okay, now, for example, if you sell coffee, all right, if you have a cafe business, right? Now, every day your customers walk in, they buy coffee from you, they buy cakes from you, they buy the condiments from you. Those consist your income, your revenue, right? The sales generated from your customer. Now, of course, in order for you to be able to sell your products, you've got to buy those raw materials, right? Now, those are what we call the cost. All right. For example, in our very simple scenario of a cafe, our cost will consist of the money we paid for the coffee beans, the money that we paid for the sugar, the money we paid for the utility bills, the rental, the salary that we pay our staff, so on and so forth. Okay. Now, so what happens when we take the total amount of sales we generate in a fixed period of time, say a year, all right, and we minus all the total costs that we pay, all the costs that I mentioned just now, including taxes, what you have at the end is what we call the bottom line, or the profits. Sorry, the net profit. Yeah. Let me just clear this first. Okay. The net profit is what we call the bottom line. Okay, basically it shows you how much profit the company generated in that year. Now, after that profit, you pay the dividends to the shareholders. Now, for example, I think there are probably about 100 of you today listening into this webinar. Say each of us, buy a share in this company. All right. So let's say at the end of the year, so me as your managing director or your CEO of this cafe business, I tell you, hey guys, so this year we made a revenue of say 500,000, but our total cost is 400,000, right? So including my salary as well. So the net profit, okay, for this year is 100,000. Now, as a shareholder of this company, you'll be demanding to have a share of the profit, and the management can share the profit in the form of dividends. Okay, all right. So that's the basic gist of what the profit and loss account is. The profit and loss statement is. Okay, then comes the balance sheet. The balance sheet basically tells how much the company owns against how much the company owes. All right. Of course, when you run a typical business, normally we may take loans from the bank, all right, or we may owe our suppliers. When our suppliers send us the raw materials, the coffee beans, the sugar, we may not want to pay them directly. They may give us a credit term, say 30 days, 60 days, 90 days, so on and so forth. Then we can pay later on. So these are considered liabilities that we have to our suppliers. If we borrow these loans, if we get any loan facilities from the bank, these are also what we call debt. Yeah. Then how about payables? Payables are something that the amount of money that our clients owe us. Okay, for example, our good friends who may come to our cafe, say, hey, David, can I get a cup of coffee? All right, say, yeah, why not? Here's your coffee. And they say, hey, but I forgot to bring any money. So I said, sure, no problem. Since you're my good friend, I trust you're going to pay me. You can pay me next time you visit me again. So hopefully he comes back. Now that is what, that's not payable. This is what we call receivables, money that we are supposed to receive sometime down the road. So the balance sheet basically, in a very simple term, captures how much money that we owe, so we own, as well as how much money or assets that we owe to parties. All right, and the balance sheet must balance between the two. Okay, it must balance between the assets and equity as well as the liabilities. But I mean, that's a bit too detailed for this webinar. So for the purpose of this webinar, just understand that the balance sheet captures how much the company owns and how much it owes. So later on, I'm going to go through a very simple case study with you guys. Okay, don't worry, it's very simple. In fact, you'll be laughing after this webinar. Oh yeah, making money from the stock market is so simple. Okay, now, last but not least, and the most important one, in my opinion, is actually the cash flow. Okay, now, I'll explain why this is the most important in my opinion. But first, take a look at the cash flow statement. The cash flow statement is made up of 3 mini statements, I would say. Okay, the first one is the cash flow from operating activities, cash flow from investing activities, and last but not least, cash flow from financing activities. Now, basically, the cash flow, which means the cash in and out, all right, of the business that is related to operating the operations of the business. For example, in our cafe example, all right, when a customer comes to our shop, they buy food and they buy drinks from us, that's what we call an inflow of cash because they pay money to us, all right, when we deliver the goods to them. Okay, but at the same time, don't forget that when our suppliers send us the materials, they ship the raw materials to us, we have to pay them money. That's what we call cash outflow. So the cash flow from operating activities are the net cash transaction from this arising from our business operations. Okay, right? That cash flow from operating activities, in my opinion, is one of the most important parameter or most important aspect that we have to understand, all right, when we analyze the business. Now, then what you may be asking me, David, what's the difference between cash flow from operating activities and cash flow from profits? Sorry, what's the difference between cash flow from operating activities to net profit in a P&L? Okay, now, there's a term that you have to understand when you analyze financial statements is the word accrual. A-C-C-R-U-A-L, accrual. Profit and loss statement is based on accrual accounting. Okay, meaning if this profit and loss statement is for the financial year, let's say from January to December. Okay, now the profit will include what we call cash transactions as well as non-cash transaction. Now you may be asking me, hey, what's non-cash? Now, give a very simple example. Say during the AGM of our business, you as a shareholder, you came up to me and say, I report to you and say, guys, so we have $100,000 worth of profit this year. But, okay, because we have old machines, we have old coffee machines, our furniture is already, we've got to buy new ones. Okay, now let's say we spend $100,000 to buy new machines. Now, if we recognize that $100,000 is used to buy the new coffee machine in that year, what will become of our profit? It will be zero, right? Now, as a shareholder, would you be happy if the director or the CEO reports to you, this year we have absolutely no profit at all? You won't be happy as a shareholder, aren't you? Why? Because if there's no profit, you don't get dividends. Yeah. But then our friendly CFO, Chief Financial Officer, will come and say, hey, wait, hold on, guys, hold on. Because this coffee machine, the new coffee machine, can be used for 20 or 10 years, for example, we do not have to recognize the $100,000 in a single year. So what we can do is we can slowly depreciate this investment over the next 10 years. So if you take 100,000, for example, you divide by 10 years, so this is basically average of $10,000 per year, right? So in this case, you take the profit of $100,000, take away the depreciation of $10,000, you still have $90,000 of net profit at the end of the year. And shareholder, at least, as a shareholder, you'll be happy because at least from the $90,000, you can get some dividends. All right. Now, on this, the depreciation cost is what we call, what we term as a non-cash transaction. It is just basically accounting term. It doesn't mean that every year for the next 10 years, the management has to take out $10,000 from the pockets to pay somebody. All right. It's basically an accounting treatment. But when it comes to operating activities cash flow, the numbers that are captured in this statement are the pure cash transactions. Okay, business can be profitable, they can report positive net profit, but they can have negative cash flow. So be careful with that. Now, what we want to look for as a value investor, okay, is we want to look for companies that can generate very strong or very consistent cash flow from operating activities, okay, over the long term. Why? Because cash flow is important to run the business. We need cash flow to pay bills. We need cash flow to pay our salaries. We need cash flow, to sustain the business. Yeah. Okay. But that doesn't mean that profit is not important. Profit is important as well, but we look at it in a different angle. Okay. Now, the other two cash flow statements, I'm not going to talk about them today. Basically, cash flow from investing activities are what we call the CapEx, all right, the capital expenditure, the money that we pour back into the company to grow the company. For example, when we buy the new coffee machines, it is considered part of investing activities. When we sell off old machines, we get some money back. That is also part of investing activities. Financing activities consist of cash flow generated from taking loans, to paying principal, paying interest. Dividends also falls under the financing activities cash flow. So that's basically it. Simple. Understanding how to analyze a business. Okay, let me recap. So we start from the profit and loss to find out whether how a company performs in that period. Okay, then we use cash flow to understand what are the real cash transactions that has what are the real net cash transaction arising from this business. And last but not least, we look at the balance sheet to understand how strong is the company's position in in terms of its assets as well as its liabilities. Okay, right. So if you have any questions, feel free to drop your questions on the panel later. Shane Chunxian will help me moderate after this, during the Q&A session. Okay, now let's talk a little bit about valuations. So just now we understand how do we look at the business from the financial statements angle. So, but how do we know, okay, whether a business is cheap, or is it time to buy? Is it time to invest in the business now? Or is perhaps the price is too high now? Okay. Now, basically, this activity is what we call valuation. Now, in our case, when we value a business, all right, we don't look at price, because price to us is very superficial. Price can be manipulated in any market, not just Bursa, not just Malaysia. It's manipulated everywhere around the world because price changes every day. Price changes every second. So does that mean that the value of a business also changes every second? Not necessarily. Okay, so instead of price, we look at what a parameter called the yield. Okay, now the yield is actually a parameter that that includes the price of the stock or the asset, as well as the income return generated from the business. Okay, let me give you an example. If you bought a house for $100,000 sometime, let's say you get a cheap sale, you buy a small apartment for $100,000 today, which is basically quite impossible. All right, and let's say every year you get a rental from that $100,000 apartment. Say you get a total rental of $10,000. 10,000 ringgit every year. So if you take income return of 10,000 here, and we divide by the market price of 100,000, All right, that basically gives you 10%. Okay, now you may be asking, is this 10% a good investment? All right, so how do we know that this 10% is a good investment? All right, now every time it comes to yield, we will compare the yield with a asset class called the risk-free rate. Risk-free rate, the RFR. Okay, now RFR basically means it means an asset class that theoretically has no risk. For example, when you put your money in an FD in any bank in Malaysia today, all right, that is the closest risk-free rate asset which is available to us as a retail investor. Okay, I think these days you can get FD rates, I think between 3.5% to 4%. Okay, now let's assume the risk-free rate or the FD rate outside now is 4%. Then you can compare that 4% with your rental of 10% in our previous example. All right, now then does it make sense for me to actually impart $100,000 to buy this apartment that cost me $100,000 today in return for a 10,000 ringgit rental every year? All right, of course, in this case, it makes sense because 10% is much higher than 4%. Okay, but what if you have another apartment, also this $100,000, but the rental, because maybe it's in a less conducive neighborhood, maybe the rental is only 4,000. Okay, so if you take 4,000 divided by 100,000, that's 4%. Okay, now in this case, this 4% may not sound so good or may not sound so attractive, because if you put that 100,000 in FD, which is basically risk-free to us, all right, you get the same return. So why should you put the $100,000 in the property, all right, and to get the same yield? Okay, now if you understand this concept, it is exactly the same when it comes to stock. Okay, now stocks, of course, you don't have rental yield. Basically, for stocks, there are two simple yields that we normally refer to. The first one is what we call the earnings yield. Okay, the second one is called dividend yield. Now, earnings yield basically is how much the company generates in earnings, in net profit per share, okay, divided by the stock price today. For example, if you have a stock that is trading at $1 today, and the earnings yield is, the earnings per share is 10 cents, all right? So if you take 0.1 or 10 cents divided by $1 multiplied by 100%, that's 10% earnings yield. So of course, in this case, it makes sense to, in terms of valuation, that to put your money, in this investment for the stock rather than putting a risk-free, because risk-free rate gives you 4%, the earnings yield of this business gives you about 10%, about 2.5 times. Okay, but that is on the accounting angle. How much the earnings, how much money that this company can give you in return for every year, assuming the net profit is consistent every year. So that's a big assumption. Now, on the other hand, we can look at the dividend yield. The dividend yield is how much the company pays us in dividend from the net profit, from the earnings every year, and we divide the dividends per share divided by price. Okay. Now, for example, if the stock price is trading at $1 today, and the company is able to give us a dividend of 5 cents, all right, per share. So if you take 5 cents divided by a stock price of $1, that's 5%. Okay. Now, if you may be asking, hey, is 5% a good a good level for me to start investing in this stock? Well, it depends on you. To some people, 5% may be fantastic. Okay. To some people, 5% maybe not so great. Now, let me give you a very practical example. In Malaysia, we can get a FD return of maybe 3 to 4%. So perhaps 5% is not that great, not that attractive. But say you live in Singapore and you have a Singaporean bank account. Do you know how much FD rate you're getting? All right, I don't know what's the market rate right now. Probably you're getting less than 1% or somewhere around there. Now, in that market, in that situation, 5% looks like a very good investment deal, right? So that is why it's very important for us to look at the valuation of a business based on the yield and not just the stock price. Now, of course, if the company can give us a dividend of 5 cents consistently, and suddenly because of any bad news, the stock price from $1 crashed to 50 cents in say 3 months, all right, your dividend yield will have increased from 5% to 10%. assuming the company can still give you 5 cents dividend the next year. All right. Now, this is one of the ways we use yield to gauge whether a company is undervalued or expensive. Take it from the other, take it on another angle. If the stock price for whatever reason shoot up from $1 to $2 in the short term, but they still maintain a dividend of 5 cents, okay, your dividend yield would have decreased from 5% to 2.5%. Now, in this case, it's obviously low. 2.5% is lower than our FD rate. So that could be a sign that probably the stock is rather overvalued at $2. Okay, so that's a very simple way we look at valuations of a company from a timing perspective using the yields. Okay, of course, this is not the only way. What I shared to you today is very practical, very easy way to use. All right, you can just use this right away after this. All right, but what you need to know is, of course, these information like earnings per share or dividends per share, the stock price, as well as what is the risk-free rate in your investment environment. Okay, now don't worry. So next, what I'm going to do is I'm going to go through a very simple case study of how we use this from the financial statements, all right, to the yields, okay, as well as how we use the 52-week strategy to find undervalued stocks. Okay, now for this, I'm going to talk about one of the things that I love to do other than making money. All right, I'm a coffee person. Okay, every day I need to drink at least 2-3 cups of coffee. Okay, now you notice that actually the coffee trend around the world is picking up. Even China, China predominantly, historically, is a tea drinking nation. But over the past, say, 5 to 10 years, the coffee culture has started to pick up in China because I think it's made popular by Western cultures as well as Western brands like Starbucks or Coffee Bean, right? If you were in Shanghai, I guess during the World Expo year, I forgot which year is that. I think it was 2009, 2010. Right? I can't remember. If you're in Shanghai, then trust me, it's very tough for you to find a good cafe, a place that serves good coffee in China. Today, if you go to China, you go to big cities like Shanghai, Beijing, Guangzhou, Shenzhen, all these places, right? You get coffee shops everywhere, every corner. In fact, sometimes the same T junction, you get 2 Starbucks, all right, facing each other. Okay, that's the actually coffee culture has picked up globally, and the thing about coffee drinking culture is when you first pick it up, you like to go to the cafes to drink because it is where you enjoy the time with your friends, right? You order a cup of coffee, you sit down for the next 1 or 2 hours, you talk and you drink coffee. But over time, what we notice is the coffee cultures tend to shift from shops, all right, from outside, from the cafes to the home. Now, if you go to a typical country like Europe, especially France, especially Italy, or US, okay, you notice that a lot of families, they have these coffee machines at home. All right, I used to have a colleague when I was working at Alcatel-Lucent. This guy is a Filipino. He told me he has 3 coffee machines back in his country. All right, one in his office, one at home, and I think the third one, God knows where he put. Maybe he's all right. Okay, so what I'm saying is the coffee culture has already also going into the homes of our households. All right, and so what has got to do with us? All right. We have this company which is listed on the Bursa Malaysia called UG Tech. All right, and if you Google UG Tech and you look for the Wikipedia page, you find that UG Tech is actually the largest producer of coffee machines module in the world. All right. Okay, you'd be surprised. Actually, Malaysia, we have got a lot of good companies. All right, we are the largest. Malaysia is the largest producer of gloves, rubber gloves. Malaysia is the largest producer of condoms. All right, we are the second largest nation that exports palm oil, and right here we have one company that is the largest producer of coffee machine modules in the world. Now, you may be asking me, what is coffee machine modules? Okay, now when you buy a laptop, you have this chip, all right, which is made mostly by Intel, okay, and that chip actually powers the processing of the laptop. When you buy a smartphone or a handphone, the smartphone has a chip as well, all right, that runs the OS for you. In a coffee machine, we also have what we call the coffee machine module, all right, and these modules are mainly produced by this company called UG Okay, now UG makes control modules for almost all the major all the major brands of coffee makers like Jura from Swiss, Krups from German, Bosch from German, Siemens, Nestle, so on and so forth. I'm sure if you are a coffee lover, these names should be you should know the names of some of these brands. Yeah. So now next what I'm going to do is I'm going to use the financial data which is available in Bursa Marketplace. All right, you should be familiar with this as well. All right, to study what is the fundamentals of this company called UG. Okay, so what I'm going to do now is I'm going to go to Bursa Marketplace. Or basically the URL, as you know, is bursamarketplace.com. Okay, now hopefully you have signed out as a user already. So right now I'm just going to use the free version. Okay, what you can do is you click on the magnifying glass. Okay, and you start to search UG. Okay, now you have a search. You have this result called UG Tech. Stock code is 7100. Okay, you just click on it. Yep. Okay, so basically this is the dashboard of UG Tech. Okay, the price. Oh, look at this. The price as of today is $2.53. It is down more than 3% from yesterday. Wow, down almost close to 10 cents. I didn't know that. Okay, now, so how do we use what we learned just now? All right, from the P&L to cash flow, the balance sheet, to the yields, to look at this company, all right, to gauge whether this is a potential company for us to invest in. Now, please remember my disclaimer. This is purely for case studies, so I'm not asking you to buy. I do not. All right. Okay. So let's go straight to the point. Now, if you scroll down from the homepage, you will see this tab called Home, Profile, Charts, Analyst, Consensus, Research, so on and so forth. I want you to click on Financials. Okay. Click on Financials. Okay. Now, after you click on it, you will have the 4 tabs: the key stats, income statement, balance sheet, and the cash flow, right? Okay. Now, let's look at the income statement for a bit. Okay. Now, if I flash back to you, so what are the important parameters to look at in the profit and loss of the income statement? Remember, revenue. All right. So to simplify things, let us look at revenue and net profit of this company. Yeah. Okay. Now, if I zoom in for you guys a little bit, now can you see here? Okay, in this case, now, so we read from the right to the left. The latest financial year that was reported by UG is financial year 2017. This company reported a total revenue of 136 million Malaysian ringgit. Yeah, 136 million. Okay. Now, if I ask you this question, is this a good revenue? You can't say, right? Because you have no reference. So that is why it is very important that when we analyze financial statements, we cannot just look at 1 year alone. What we need to do is we need to look at the time series. All right, the longer the better. So Bursa Marketplace provides us a free 5 years data. So in this case, it is between 2013 to 2017. Now, study this revenue of this company, UG from 2013, which is where they reported about 94 million ringgit worth of total sales, to 136 million. All right. Now, ask yourself this question. Did the revenue of this company grew in the past 5 years from 94 to 95 million to 112 million, 120, 121 million to 136 million, right? So it is very obvious that this company is growing, all right, over the past 5 years in terms of the top line, in terms of the sales. Yeah. So next question is, yes, the revenue is growing, but are they profitable? All right. So for the same thing, let's look down at, okay, so as you can see, after revenue, we consider all the costs, all right, and we look for this thing called the net profit. Now, I think Bursa Malaysia, Bursa Marketplace, they don't use the term net profit, they use the term net income. Let me just, here. They use the term net income. All right, so ask yourself, is this company profitable? Do they have net profit in financial year 2015? Yes, they have. They reported actually a net profit of 70 million ringgit. Okay, but again, as I mentioned just now, looking at this number in a year alone does not tell you much. But if you look at this number over the past 5 years, then it should give you a better picture. In 2013, okay, UGTech reported a net profit of 39 million. The year after that, 40 million. 49 million, 55 million, 70 million. All right. Now, it is very obvious that the company is actually growing in the past 5 years in terms of revenue as well as net profit. Yeah. Okay. You get that? So this probably is a good company for us to start looking at. Yeah. But don't forget, for a company, it's good that a company is profitable, but is the management sharing the profit to you as a shareholder? As a minority shareholder in terms of dividends? All right, simple. So what we're going to do is we're going to look at, scroll to the line whereby we can compare the dividends against the net profit. Okay, so in this case, what I'm going to do is I'm going to use the earnings per share. All right, which is we will talk about here, the earnings per share. So how we derive earnings per share is we take the net profit of, let's say in this year is 70 million. We divide it over the total number of shares which is being traded for this stock in the market, okay? Then we get what we call the earnings per share. So it's basically like a net profit per share, okay? So for UGTech, their earnings per share for financial year 2017 is 16 cents per share. Yep, 16 cents per share. Now, in that same year, the management declared a 15 cents dividend to all the shareholders, themselves as well as you as a minority shareholder. So if you take 15 cents divided by 16 cents, that's close to 100%. Now what this means, all right, is the management actually gave a close to 100% payout from their earnings, all right, for the common for the normal dividends. Okay, and did they do it only 1 year? Or they have been consistently doing it. Okay, let's look at 2013. They made earnings per share of 10 cents in 2013. They declared a net profit of 9 cents. That's close to 10 cents as well. The next year is 10 cents, 9 cents dividends, 12 cents earnings per share, 11 cents dividends, 13 cents per share, 13 cents dividends, 16 cents per share, 15 cents dividends. Now, ladies and gentlemen, this is a very important angle that we are looking for when we invest in a company, because this shows you whether the management is are they generous enough, or are they really honestly sharing the profit with you. Now, of course, we do not expect all the companies listed on Bursa Malaysia to give us 100% payout. Okay, even 60-70% consistent payout is good enough for us. Sometimes even 50% is good, depending on the type of business. Now, are there a lot of companies like UGTech listed on KLSE that gives us close to 100% payout? Definitely. On top of my head, one of the stocks that all of us know, they give us it gives us 100% payout consistent for almost 20 years already, and this company is called Nestle. Nestle is something that you and I, buy or consume every single day. All right, and perhaps you can use this as a homework after this webinar and go back and use Bursa Marketplace to understand what is Nestle's value as a business. Okay, so we talk about this. We talk about revenue. We talk about profits. We talk about dividends. Okay, now let's take a look at balance sheet for a bit. All right, for this case. For this case study, I'm just going to simplify things by looking at the cash position of this business against its total liabilities. Okay, now for this, we go back to Bursa Marketplace. So we look at the balance sheet. Okay, All right, so there you go. So under the balance sheet, let's look at cash and short-term investments. So basically what it means is the cash in hand, the cash in the FD, in the savings account, in the current account, as well as short-term investments that is easily converted into cash in say 12 months. All right, this is what we call short-term investments. All right, and we lump this together to classify them as cash. For UG Tech, the total cash they have as of the end of 2017 is 243 million ringgit Malaysia. Okay, now whether this is a lot of money actually depends. We have to look at it in context to the total liabilities. Okay, now let's look for the total liabilities in this company. So if you scroll down, okay, let me see if I can scroll down. Scroll down. Total liabilities. Yeah, there you go. Total liabilities. So what I'm going to do now is I'm going to print screen. All right, I'm going to put it here so that we can see later. Okay, so this is easy for you to compare. Okay, now. So I'm going to just give me a second here, please. Good. So what I'm showing in front of you is I'm putting it in the view so that you can easily compare, all right, the cash as well as the total liabilities of this business. Now, take a look. Just take a close look at this. In financial year 2017, UG Tech has a total cash of 243 million. All right. At the same time, they have a total liabilities of 106 million ringgit. So, what can you say about the strength of the balance sheet of this company? Are they strong? All right. Now, we can see from we can look at this in this way. Say you have 243,000 in your bank account, cash, and at the same time you owe the credit card loans, you owe personal loans, you owe house loans for a total of 106,000. Do you consider yourself financially free? All right. Do you consider yourself having no debt at all? Of course, because you have 243,000 in your bank, and you owe the bank in total 106,000, which you can pay off if you want directly, and you still have 100 over 1,000 ringgit in cash, right? Now, it is the same for this company, UG Tech. As of financial year 2017, the end of this financial year, they have in total cash of 243 million, out of which they owe 106 million. So if the management want, they can pay off the 106 million right away, and they still would have been left about 140 million in cash, and that's a lot of money. And again, we don't analyze this for 1 year. We analyze it over a time series. If you can look in front of you, all right? Okay, 2016, they have 200 million in cash. They got 51 million in liabilities only. So they're still net cash. The same thing for 2015. The same thing for 2014. And the same thing for 2013. So from this angle, we can say that UG Tech has a very strong balance sheet. In fact, they are their own bank because they do not need to borrow anything from the banks, right? Yeah. Now, of course, if you ask me, are there a lot of companies like this in KLSE? Yes, definitely. You just need to have a look. Now, personally, as a very risk-averse value investor, I like this kind of companies because I want to be able to sleep well at night, even though there's a financial crisis out there. Because I know that for whatever happens out there, my company will be able to fund its business from its cash position. Right. I know that its balance sheet is strong enough to withstand any downturn, possible downturn for maybe an extended period of time. And that is the margin of safety that I look for. Okay. Okay. So that's basically the balance sheet. Now, last but not least, how about cash flow? Okay. Now, cash flow. We talk at length for the operating activities cash flow. Okay. So I'm going to go back and look at the cash flow. So let's look at cash flow for UG Tech. All right. Now, we look for cash flow from operating activities. Yeah. So that's very important. Let's look for cash flow from operating activities. And here we go. Cash flow from operating activities. Okay. So again, UGTech, they recorded a cash flow, net cash flow of 68 million from operations in 2017, 55 million from 2016, 47 million in 2016, 49 million, 46 million. Is this good or not? Is it strong or weak? Now, to answer that, we've got to look at this in context, and we've got to compare this with the net profit. So what I'm going to do is I'm going to snapshot again. All right. Oops. Okay, just give me a minute, please. Okay, so I'm going to snapshot this one. Put it here. Okay. Okay, and after that, I'm going to go back to Bursa Marketplace to show the income statement on the profit and loss. Now, why I do this is because I want to compare how much is the cash flow against the net profit or the net income of this business. Okay, now, so if you can see here, so what I did was basically now, yeah. Okay, I'm sorry, I did not capture it well. Okay, I think you should be able to see this in front of you now. All right. Okay, now look. In financial year 2017, UGTech recorded a net profit of 70 million. Now, at the same year, they recorded a net cash flow from operating activities of 68 million. So it's very close. The year before that, 55 million in net profit and 55 million in cash flow. 49 million in net profit, 47 million in cash flow, so on and so forth. Now, from here, we can deduce that actually this business is really generating very strong cash flow for the business. And this is one of the traits that we really always look for as value investors in any business that we invest in. So this is one of my main criteria when I choose a stock to invest. The business must be consistently able to generate cash flow, and preferably the more the better, which means if the cash flow from operating activities is higher than net income, the higher the better. Yep. Okay, so that's basically it for the financial statement. Easy, right? Okay, then how about yields? Okay, for the yields, I'm going to simplify things again by looking just at the dividend yield of this company. Now, if I go back to a Bursa Marketplace and I just click on key stats, oh no, okay, maybe not. I just click on the home. Where is UGTech home? The snapshot. Let me look for the snapshot. Okay. Now we can see that UGTech, it's not here. There you go. There you go. Now, under the home page, we saw that based on the last closing price of $2.53. Now, we know that the UGTech paid a dividend of 15 cents, okay, excluding the special dividend. Just let's look at the normal dividend. If you take 15 cents, all right, 0.15 and divided by the stock price of $2.53, okay, and we multiply by 100%, we get 5.92%, which is shown here. Okay, I think maybe this is not updated, but basically it's about 5.7, 5.9%. So you've got to ask yourself, is this a good investment, in terms of dividend yield? And I may say, with close to 6%, it's much better than my FD. Right, so probably this is a good buy. This is a good potential candidate for me to invest in based on the dividend yield. Okay, so you can apply these methods when you choose your stocks. Okay, from what you learned today, basically from the understand the business, from the financial statements, all right, to the simple valuations using dividend yield or earnings yield. Okay, it's simple, yes. Do I use it? Definitely. This is the core criteria or the core steps that I normally employ when I do stock picking. Okay. Now, I think that's basically it for me for this simple, short 1 hour session. In fact, I hope to have more time with you so that I can actually talk more about case studies perhaps next time. So, Chun Xian, are you there?
Yes, I am here.
Okay, great.
Thank you so much.
Thank you. Over to you.
Yeah, thank you so much for an excellent presentation and sharing on the principle of value investing. I'm sure that many of them would have questions that they want to ask you. So if you have any question, you can write it in the question box. In the meantime, just let me take back the control. Okay, hang on, yeah. Okay, all right. So I believe you are seeing my screen now. Well, David, you can still you can still show your webcam. No worries. All right. So we have a lot of questions. So now the first question is there any simplified formula to calculate intrinsic value? David, they can't hear you. I think you have muted yourself.
Okay, got it. Can you hear me now? Okay, sorry about that. I'm a rookie when it comes to webinars, yeah? Yeah, okay, intrinsic value. I guess this is something that I should expect, every time we talk about value investing, people tend to associate with intrinsic value. So I guess a lot of people are looking for, okay, what is the intrinsic value of the stock, so that I know if it falls below intrinsic value, I know that it's undervalued or otherwise. In my personal opinion, I do not actually subscribe to the notion of intrinsic value. Of course, if you Google intrinsic value, there are thousands of formulas. And don't forget, in order to derive that formula, you have to have a lot of assumptions as well. For example, you have to assume a certain growth rate of the company, whether it's revenue or net profit or dividends. You've got to assume a certain discount rate, you apply when you do your ROI, So there's a lot of assumptions built in. Now, personally, I don't use intrinsic value when I value a business. Okay, as I shared just now, let me go back to here. I use the yields, all right, the information from the yields to value, because it's more practical for me, because I can compare the yield that I derive from investing in this business against other asset class, like maybe it's FD or my EPF return, so on and so forth. Okay, now if you know, this is a guy called Mr. Professor Bruce Greenwald, all right, he is a famous economist. He has this very famous quote. He says that when you put your money investing in a risky asset like stocks, all right, your yield that you're looking for should at least be 2 to 3 times more than what the risk-free rate gives you. For example, if my risk-free rate is between 3 to 4% right now for FD, right? When I look for a business, when I want to look for a stock to invest in, this stock should give me a yield or earnings yield of at least double of that. So that would between 6 to 8% for me to consider it is undervalued. So that's just an example. Okay, you can also apply the same the same logic when you use dividend yield as well, and so on and so forth. So to answer your question, I didn't get a name. Sorry for that. I personally do not use intrinsic value. Okay, right.
Excellent. All right. So the next question is on how do we differentiate between a good management versus a bad management? Anything we need to look out for?
This is an excellent question. Okay. All right. So there are basically two ways to look at this. Firstly, we can actually understand or try to guesstimate the quality of the management from the financial numbers. Now, in this case, all right, as I shown just now, sorry, I realized that you don't see my screen, right? Can
Yes,
I have the
you're
screen
right.
back, please?
No problem.
Yeah.
I am.
Sorry about that.
Yeah, you're the presenter now.
Okay. All right. Thanks. Yeah. Okay.
Yeah.
Now. All right. So one of the simplest way for us to gauge the quality of the management is through the dividends payout. Now, when I talk about dividends, I do not mean the dividend policy. Now, I know a lot of companies out there, they have this policy, say they're committed to pay 30% or 40% of the net profit every single year to the shareholders. Now, that is not what I'm referring to. What I'm referring to is the dividends they pay out every year, and you can see that. You can see the information from your Bursa marketplace. Under financials, under the profit and loss, income statement, where we show the dividend payout, or you can use the dividends per share to look at it. And in our previous case study, we saw that UGTech is a company that pays out almost 100% of the dividends every year. So that is a very good, I would say, simple, clean, and easy way for us to gauge the management quality. Now, secondly, what I implore every one of you to do is every year you've got to find time to visit your management. And how do we do that? We go to the AGM, what we call the annual general meeting. Yeah. Now, why want to go to AGM? Definitely not for the door gift, although it is a bonus. Okay. The reason why I want to go to AGM is to meet the management, look them in the eye. All right. And ask them questions related to our business. Now, for example, if the business revenue went down in the previous financial year, say for whatever reason, we can question the management. What happened? All right, what happened to our business, or what is the management going to do about this situation? How are we going to turn the business around? So on and so forth. Or we can question them about certain of the actions that they did in the previous year. Say, they bought certain assets and we're not, we're concerned about it. We can raise these questions during the AGM. And more importantly, we have to see how the management answers our questions, because that will give us a level of confidence about the quality of our management, as well as whether they are transparent to us as minority shareholders. Now, if you follow Warren Buffett's principles, you know that Warren Buffett actually he put a lot of stock on the quality, the management quality of his businesses, and I can't agree more with him. Yeah. So I hope I answered your question on that. Yeah, thank you very much.
Thank you, David. So the next question is, there are many counters in Malaysia, and so how should we nail down to the potential counter in order to shorten the list further for good stocks?
Oh, okay. Another great question. Hey, are you sure these guys are not seasoned investors?
Yeah,
Okay, now
this question.
Right. Now for my case, so I've prepared a special slide for you guys. Sorry, yeah. Okay, now you can see in front of you. I hope mine is on. Yeah.
Yeah.
So you can employ tools which is available around in the internet, or from subscription services. You can do some sort of filtering. You can filter certain dividend yield, earnings yield, PE, things like that. But I don't do that. So my approach to investing in how to know which stocks to pick is I use this very simple strategy, which is in front of you right now. I call this the qualitative before quantitative approach. Okay, basically it means before I cherry pick a stock to invest in, before I decide I want to even spend time to study a company, I look at the macro picture first. So I do a top-down approach. I look at the entire market and I ask myself, okay, what is a good industry to invest in right now? For example, we know that everyone is having a smartphone. Every single, even my 3-year-old kid, can't live without a smartphone because of YouTube, things like that. So electronics, in this sense, plays an important role in our daily lives, whether you agree or not. Okay, in the future, there will be more and more electronics. You will have autonomous vehicles. We have more and more EVs, electric vehicles, and we have more advanced consumer devices, smartphones, TVs, things like that. So electronics plays a very important role. So that's my macro picture. In the long term, in the future, the electronic sector will be getting more and more important, as well as ingrained into our daily lives. And good news is because Malaysia, as a export nation, a lot of people say Malaysia is an oil export nation. True, but a lot of people do not realize that most of Malaysia's exports came from electronics, like integrated circuits, computers, ICs, telephones, semicon devices shown in front of you. So this is the statistics for a 2016 Malaysia exports available from this link. You can go and check it out. atlas.media.mit.edu. All right, you can view a lot of countries' data. So now, almost half of Malaysia's exports came from electronics. And that's why I believe that we are in a very good position, to benefit from the growth of technology, electronics in the future. Now, from there on, say I want to look for companies that produces, components for smartphones, then I can do a bottoms-up approach. I can cherry pick, find out among the listed technology counters in Malaysia, which are the ones that are producing components or delivering services for these companies like iPhone, like Samsung, or for Huawei, so on and so forth. We identify companies with good and potential growth prospects in this sense, and at that level, at that stage, then it will become important for us to study the financial statements of this company, the time series performance. Then we can look at the timing of this company after at that stage. Yeah. So basically, that's how I do it. I hope I answered the question.
Yeah, definitely. So, well, the next, just give me a minute. So the next question is about VS industry. Yeah, so recently the share price dropped a lot, I think like 30%. So do you recommend, what do you think about this counter? This very counter specific question asked by one of the audience. So yeah.
No worries. Electronics is actually my forte. I used to be an engineer. Okay. Now, first of all, you've got to understand what is the business model of VS. Yeah. A lot of people actually, in fact, they compare VS to UGTech before. Now, so the person who asked these questions, can I suggest you to go back, after this webinar, to use Bursa Marketplace and compare the fundamental data for the P&L to balance sheet, to cash position, to cash flow of UGTech against VS. Yeah, that's the first step you have to do. Now, secondly, you have to understand, what does VS produce? UGTech produce coffee machine modules. And what does UGTech produce? Now, for my very limited understanding of the business, by the way, I have no shares in VS. Number one is they are actually an EMS. All right. Now, UGTech is what we call an ODM, original design manufacturing. That is why they are a very profitable business. Whereas for VS, they are mostly what we call EMS, electronics manufacturing services supplier. Basically, they are contract manufacturing for their clients. And I understand from my circle of investors that VS, one of the biggest customer is Dyson. So of course, recently, because Dyson is very aggressively expanding, that's why they get a lot of orders from Dyson. So, all right, that's why the share price goes up. Now, for whatever reason, I think not just VS, most of the electronic stocks that I know of has corrected in price for more than 20-30% in the past, I think, 1 month. All right. So you've got to ask yourself, is this a market reaction, or is there something structurally wrong, or is there something that I should be concerned about in this business, in the VS, for example? Now, perhaps I can throw you an angle that you need to look at, which is the trade war, which is potentially happening between US and China. So now they are throwing each other all these threats, like the IP theft, national security, and this has very negative implications to all the technology stocks, because if you look at the entire value chain of this electronics industry, right, it is very diverse. All right, we have components which is manufactured in Malaysia, in South Korea, in China, so on and so forth, that is being assembled and shipped to US. Okay, so VS, as part of as a electronics, as an EMS player in this space, I think they are not safe from the trials and tribulations of the recent market sentiment. Yeah, so why it dropped 30% beats me. I'm sorry, I don't know what's happening. But the most important is you have to ask yourself, is there something wrong in this business, or is this an opportunity for you to buy a good business at a cheaper price? Yeah, I think that is the more important question.
Yeah. So the next question is, do you cut loss in value investing?
Wow, that's a great Great question. Do I cut loss in value investing? Well, cut loss is a very technical analysis term, in my opinion. I used to be a technical analyst for the past, before I became a value investor for about 7 years. So I learned my own. So cut loss is a very central strategy that every chartist must have. Now, as a value investor today, what I do is I don't cut loss. I sack the CEO, meaning I fire the CEO. But what does it mean? Now, of course, we cannot expect that every time we pick a stock, the stock price will fly, the business will grow. Now, sometimes we may encounter a situation where we made the wrong decision. Okay. Now, if we ascertain or we are sure that our analysis of this company was wrong before, then it makes sense for us to sell the stock. And it is very important. Don't be a long-term shareholder for the sake of emotional baggage that you hold on to. You bought the stock at a high price, now it has tanked down, and you feel very you feel very how to say sayang in the Malay word, to let go of this stock, very heartbroken, right? Don't do that. Don't be emotionally attached to your stock, whether the stock is crashing or it is going up or is shooting to the moon. Okay, now I give you a very real example of what I have what happened to me recently. Since last year, I invested in this company that produces solar cells called Texang, based in Penang, based in Bukit Mingah. Right now, again, I'm a true believer of a renewable energy, and among the renewable energy that I'm very interested in is actually solar. Okay, it's cheap, it's clean, and basically, I believe solar is the future. Now, so I do a cherry pick. I look at, I found this company called Texang. Great, balance sheet very strong, net cash. They got good dividend payout, and the management is quite okay. But what I did not factor in is actually globally, China is actually dumping the market with excessive, solar cells, and they're actually throwing down the price a lot. So the US is not very happy about it, because US has their own supplier as well. Now, to cut the story short, at the share price time, I began to wonder, hey, what's happening? Is there something really wrong with the business? Are they not producing solar cells to export to China or to other parts of the world? So what I did was I made a trip to Penang in Bukit Mingah. I rent a car. Actually, this is in webinar. I don't know whether I should share this. I went to scout around the factory, and I found that, oh my goodness, there's not much production happening. There's no smoke from the chimney. I don't see any workers coming out during lunch break, and I start to wonder, perhaps maybe the production has slowed down, or the production has stalled for whatever reason. And I decided then after that trip that perhaps this I made the wrong analysis of this company before, and I have decided to sell the stock I raised. I mean, after I sell, or with whatever proceeds that I have left, I use it to buy other companies, that have better prospects, that have better, stronger balance sheet, so on and so forth. Yep. So to answer your questions, yes, we do that, but we don't cut loss per se. We don't cut loss because of price coming down. We cut loss because either our analysis is wrong, or the business there is something wrong with the business. Yep. Thank you for that question.
Yeah, thanks, David. Yeah, coincidentally, I also had some solar cells companies. I also sell it at some.
Oh, good for you. We are in the same boat then. Okay, perhaps do we have time for one last question?
Yeah, only one last question. Okay, so now the next question is, in a period of high inflation, what sector or what type of company will not get impacted, that is safe to invest? So basically that's the question.
Okay, now first of all, we got to admit, or we got to accept the fact that inflation is here to stay. Yeah, and second fact we got to accept is all companies' profitability, the margins, their net profit is going to be impacted by inflation. Why? Because the price of raw materials go up, your salary goes up, minimum wage. Government wants to tax more of the profit. everything, the total cost will go up. Yeah. So what is more important is to actually gauge how efficient is your business. All right, is the business that you're looking at, how efficient are they to manage the the extra cost caused by this inflation, as well as how efficient are they able to pass on the additional cost to the consumers. Now, I give you a very simple example. Nestle. Okay, why I use this? We use Nestle for in almost all our classes is because it's very easy to understand, and most importantly, all of us listening in, all of you listening, including myself included, we are consumers of Nestle product. Now, every time we go to the supermarket, right, we shop for Maggi meal, we shop for this Nescafe or Milo, you notice that the price keeps on going up. Now, why is it happening? All right, we know that the price of sugar went up. We know the price of cocoa went up. We know the price of coffee bean went up. All right, and over time, Nestle they command such a market share that they're able to pass the costs back to the consumer, but they do it in a very responsible manner. They don't straight away increase the price of the products right away because the price of raw materials has went up. What they do is the management is trying to manage their costs. They're trying to reduce their costs by increasing the efficiency of the operations. They are trying to source for higher quality raw materials with better better financing terms, so on and so forth. So Nestle is a company, that is what I call a natural hedge against inflation, because as long as there's inflation, we know that Nestle can price the products, the price of their products slowly upwards. So when you have higher prices for your products, naturally your revenue will slowly grow up. And assuming fixed or the same net margin, your net profit will slowly grow up. So as your net profit goes up, the company should be able to pay higher dividends in the future. So naturally, the share price should go up as well. Yeah. So are there any companies that behave like Nestle in this high inflation regime? Yes. Basically, any fast-moving consumer goods companies, or FMCGs, we call it, naturally, they are a natural hedge against inflation. So to answer your question, you can start to look at FMCG companies or food and beverage companies to counter or to mitigate this inflation impact. Yeah. So thanks for the question. Now I've got just one last slide. I have a Facebook called Financial Express Malaysia. You can click on it. I do share a lot of case studies with my students as well as the public. You just go to this website. You guys click fb.me/fixpressmy. Okay, so that's basically it for me. I hope you enjoyed my webinar tonight. Please forgive me if I have made some mistakes, because this is my first time doing a webinar live as well for you guys, and hopefully I've done a good job so that you guys will ask me to ask for a second session with me. Yeah, thanks a lot, Chun Sian. Over to you.
Yeah, no problems. Thank you so much, David. Let me take back the presenting control, show my screen. Okay, I'm sure you're seeing my screen now. So, all right. So yeah, some announcement. Yeah, as many of you who have read the budget or the recent announcement by the Prime Minister during the World Capital Symposium Summit. So World Capital Market Symposium, World Capital Market Symposium. He made a few announcements. First announcement is all new investors will be given a fee waiver on trading and clearing fees for 6 months, effective 1st March 2018, which is like last month. So if you're a new investor and if you haven't had any CDS account before, this is a time for you to go and create and open your first CDS account, and then you'll be given a fee waiver for trading and clearing and trading fee for 6 months until 1st August 2018. The second announcement is that waiver on stamp duty. So now, to encourage more people to invest in the mid-cap stocks, the stamp duty for the mid and small cap stock will be waived effective from 1st March 2018 for a period of 3 years. So how do we find companies in this range? Alright, it's basically for companies range from 200 million market cap to about 2 billion ringgit market cap. Sorry, for if you invest in this company or within this size, you are exempted from paying the stamp duty. The third is stamp duty for contract notes. Stamp duty for contract notes on exchange traded funds, ETF, and structured warrants will be waived effective 1st January 2018 for a period of 3 years as well. So if you trade ETF or trade structured warrants, then you don't have to pay stamp duty, whether you are a new investor or existing retail investors. So now we've come to the end of the webinar number 4, Principle of Value Investing. And thank you so much, David. And for the next webinar, we have Momentum-Based Indicators Masterclass. Now today we are on Fundamental Analysis. Next webinar, we'll be talking on technical analysis. And one topic is Momentum-Based Indicators. How do we use this indicator to our advantage to do charting? So the date is 8th of May. It's Tuesday, 8:30 to 10 o'clock. You can register using the link here. I've also posted it in the chat group. So you just click at the link on the chat group to register yourself a seat to the next webinar organized by Bursa Malaysia and managed by LifeChamp. So with that, thank you so much, David. For those of you who tune in, if you want to connect with David, you can go to his Facebook page, Financial Independence Express, or as well as emailing him at alpha@spiralthinker.com. With that, thank you very much, everybody. David, you have any parting words for them? Right, I think he's cool. So with that, thank you and have a pleasant rest of the day. Bye-bye.
Thank you, everybody. Good night.